Hello, everybody, and welcome to Investing with IBD podcast, sponsored by Scoofus Capital Management. It's September 21st, 2022, and it is Justin Nielsen, your host. And as always, it is also going to be Arusha Pires joining me. He is a portfolio manager at O'Neill Global Advisors. How are you doing, Arusha?
I'm doing well, Justin. It's always great to be here.
Yeah, did you get a little bloodied after the Fed announcement here? We'll talk a little bit about that, I'm sure, today.
Right. Yeah.
But we've been talking about low exposure, so hopefully not too bloodied. It's also great to be welcoming back to the show Tom O'Halloran. He is a partner and portfolio manager at Lord Abbett. How are you doing today, Tom?
Great, Justin and Arusha. It's great to see you again.
Yeah, great to see you. So we'll of course be getting into the market action, what's going on there, and also we'll get some learning lessons from Tom, the way he's viewing the market right now, and why some technical action might be a reason to be bullish. We'll also take a look at some of the stocks that are on Tom's radar. So let's get right to it, and maybe we start with the Nasdaq, Tom. It's been a tough 2022, and for any trend followers and purveyors of growth, it's been a little bit of a tough year. So is this one of those things where as a mutual fund, you can't really take your toys and go home? So what do you do in an environment like this? Do you go switch into the non-growth and the commodities, or do you just kind of stay the course? What's your plan?
Well, Justin, our investment process is flexible enough to move around. If we think of risk as a spectrum from 0 to 10, with 10 being the most aggressive, in 2020 we would have been at 10 or so.
Yeah.
And then actually this bear market that we've been in, I would argue, for at least for the innovation growth names, really began on November 10, 2020, the day that Pfizer announced their vaccine result for COVID.
Right, vaccine day.
And if you recall that day, some of the pandemic darlings like Zoom dropped big, and they've gone down ever since.
Mm-hmm.
So we're coming up on 2 years of a bear market in innovation growth names that I prefer.
Mm-hmm.
But as that has been happening, we've been transitioning out of them, and I would say we've spent most of 21 and 22 kind of at 3 or so on the risk spectrum. We'd never be 0 or 1.
Mm-hmm.
We don't hold more than 5% cash. We're a mutual fund. We manage separate accounts, but all of them expect that we'll be generally fully invested.
Right.
And we wouldn't be a 0 because we're a growth fund. So right now, I'd say we're about a 6. Because I feel as though the bear market has lasted for a pretty long time, and many of the stocks that I like are down 40 to 80% off their high.
Yeah.
But I'm seeing a lot of bottoming action in many of them, and I'm also seeing for the first time in quite a while some nice snapbacks.
Mm-hmm.
And by that, I mean stocks whose price is lifting up through their 150-day moving average for the first time in quite a while. And if there are good fundamentals behind that, we're adding to those types of names. I think it's been a huge surprise to most people how long the inflation problem has lasted.
Not quite the transitory that we were originally told, right?
Yeah, not transitory at all. And if you think back in March of 2020, the Fed thought that we might have a vaccine for 3 or 4 years,
Right.
and that we could be heading into a Great Depression. And so they really pulled out all the bazookas and probably didn't turn them off soon enough. Following the vaccine, following evidence that retail spending was quite good. And so there's been an enormous amount of fiscal and monetary stimulus put into the economy since the pandemic broke out. And that's now, coming toward an end. The fiscal stimulus is still happening, but the monetary is being withdrawn. So interest rates are being raised, QT is happening, and And, while all of this has been happening, supply has not been able to keep up with demand because we shut down the economy, we shut down the supply. So we have a situation where rates have gone higher than expected. Inflation has stayed higher for longer than expected. But I do think that inflation is in the process of topping out. I don't know if it'll come down as fast as I might hope, but I think it will come down, over the next 12 to 18 months, if not a lot sooner. So I believe that the Fed is nearing the end of its tightening cycle. I think, inflation continues to be what I have my mind on, and that really is core inflation, rent and labor. And the rent acts with a lag because you have a 1-year contract and that doesn't reprice until a year later. So there's some lag there and stickiness. And the labor situation was hurt by many deaths from COVID, people leaving work because they had stimulus benefits, and all of that is going to take some time to mend itself. But I don't think we entered the pandemic unable to get inflation up, and that a pandemic has ushered in a new era of persistent inflation. I don't believe that. I think inflation is going to come down. The Fed's going to stop raising rates. And I think they're going to be able to do it without causing a bad recession. And so I'm thinking that the stock market is bottoming. And I'm seeing especially some of my favorite innovation names are bottoming. And where I'm seeing snapbacks, I'm owning them, initiating positions, adding, etc. But we're still in the bear market. I used to read IBD religiously day to day. I started reading it when I first began with publicly traded stocks in 1993 as a sell side analyst for my first firm that I worked for, Dillon Reed. And now it's a weekly. It's the very first thing I read on Saturday, and Saturday said market in correction. And when you look at the IBD 50 and you look at the big cap 20 and you look at the stock spotlight, there's plenty of good stocks, but they're mostly energy.
Yeah.
There's pockets of strength in healthcare, but they're not the types of names that I normally like to own, like semiconductors and software. Those do not look good right now, and I own a lot less of them than I did in 2020. And, healthcare is doing very well. And we own more healthcare than we've owned in a long time. I was kind of surprised when I look at the top 10 of my developing growth fund recently. And 8 of the top 10 are healthcare names, 3 or 4 devices, 4 or 5 biotechs. And that I've been managing that fund since 2003, and it's never been that way. And that's where our investment process is leading us. And so I believe we started off by you asking me what is my process, and my process can be viewed as 3 circles. The top circle is an analysis of the quality and potential of a business. The second circle is the operating momentum of that business. And then the third circle is the technical momentum of that stock price. And so at the first circle, what do we mean by, a good business and one with a lot of potential? Well, it has a good business model, meaning that it either is now or can be profitable, nicely profitable. We find it when it's not that profitable and going to be nicely profitable, we can make more money, but we generally like good profitability. And we like the revenues to be annuity-like. So the more stable they can be, the business is worth much more. Then the management is another important consideration. So we want to invest in competent and credible managers. By competency, meaning the requisite experience and drive And by credibility, meaning honest people. I know a lot about that because I'm a former criminal prosecutor who spent
Oh.
his 20s cross-examining people.
So you can read a person a little, huh?
Yeah, well, it's interestingly enough, it's not always about reading the person. It's about listening to the person and thinking about what the person is saying against the known facts.
Mhm.
But then we want a market to be healthy and potentially growing. So, for example, electric vehicles is currently a growing market. We have a lot of we have exposure there. And then we like the leader.
Yeah.
So, I'd prefer to own Tesla versus all the others. They're the leader. I think they'll maintain leadership, and I don't care if it's more expensive than the others. So,
Mhm.
that's at the first circle. The second circle, operating momentum. Usually that means sales growth and or earnings growth. I would say in a higher interest rate environment, operating momentum has become more important
Mhm.
and earnings have become more important. There's less tolerance now for companies that are not going to earn money until, let's say, 7 years out.
Yeah.
When the 10-year Treasury was at 150 basis points, that's fine.
Right.
But when the 10-year Treasury is at 350, that's not as attractive. In a biotech, we often don't have any sales and earnings. So there we're looking at trial results
Mhm.
and estimating the market size as a way to gauge how the operating momentum is going. And then
Tom, let me just interrupt you for 1 second there. So for the biotechs, with kind of the trials, do you adjust for that risk? Or are you just going with a smaller position in some of those, maybe spreading it out among more biotechs?
We generally manage we're diversified funds. We do
Yeah.
have a 33 stock fund, the Lord Abbett Focus Growth Fund. That's 33 stocks. But I would say today our large cap growth leaders fund probably has 55, which is
Mhm.
kind of low for that. I would say if the market gets better and we start moving down cap, that would be more like 75. Our developing growth small cap fund would have 90.
Okay.
Our micro cap growth fund would have 80. There is some overlap in all of those. And so we have about 250 stocks that we own at any given point in time.
Okay.
And in biotech, it really depends upon the stage of the trial. So
Okay.
we'd be
Mhm.
more inclined to hold a bigger position if the company is doing a phase 3, or if the company has gotten approval for the drug and is launching the drug and the sales are good, that would warrant a bigger position. But we definitely we have a full-time biotech expert on our team, Samantha Shevins, and she's been doing this a long time and works very hard at it. And so we try to take positions that are as healthy as the market and the fundamentals warrant. Now today, if we look at biotechs, they were big winners in 2020. One of the reasons being that interest rates fell to 50 basis points on the 10-year Treasury, and biotechs are the longest duration asset equity, so they went up a lot.
Mhm.
And then when rates came up a lot off that low level, biotech got crushed, and then biotech had the triple whammy. Actually, the second problem for biotechs was that the clinical trials largely stopped during
Mm.
COVID. And not only that, but the FDA approval focused on vaccines for COVID rather than new biotech drugs.
Yeah.
So today, fast forward, we've already had a lot of the interest rate rise priced in. I wish it'd be better if they come back down, but the 10 years at 355 or so today. And however, the trials have ramped up again. They're going very well. And the FDA is back approving the drugs. So the biotech is an area which is more attractive to us, and we own a lot more of it. And the preference would be for the larger cap biotech, but in our small cap biotech, as I said, we have a lot of exposure.
Mhm. Now, real quick, you were talking about kind of getting back to this whole interest rate thing. You were talking about how you think the Fed may be on kind of the tail end of the hiking. Um, Now, one of the things, I mean, we had the 75 basis points today in the Fed meeting. A lot of people were, I guess, concerned that there's still some hiking looking like is being projected out. It certainly seemed like a pretty hawkish Fed still. So when you say you think they're at the tail end, what is your time frame? Are you looking 6 months out, 12 months out? What's
I think they're going to be done by the very beginning of by the end of this year,
hmm
or very early January 23. And
hmm
I think they're at 3 to 3.25 now. After they'll probably go to 4 to 4.25. I don't maybe 4.5. I don't think they're going to go beyond that. So that's what I
Yeah,
mean.
I
And
think
we're
the
up from
projection was maybe 4.6
yeah maybe
after the Fed
yeah
meeting, something like that.
yeah maybe it goes there, but it's up from 0.25. So
Yeah.
there's already been a lot. There's already been a lot of shock effect. You got to,
Yeah.
using technical analysis as we all do. You're always looking for the reaction of the market. Today wasn't encouraging, but if you remember back to March of 2020,
hmm
the Fed cut rates, the market fell. The Fed
hmm
cut rates, the market fell again. The Fed cut rates a third time, the market fell again. Then the Fed said, we're buying high yield ETFs or whatever it was, and the market went up and never looked back. So
Yeah.
it's always a matter of, the reaction to the Fed news, how much is already baked in. And we've already baked in a lot of negativity on the interest rate front, in my opinion.
hmm Well, when we come back, we're going to get a little bit more into some of the details of why Tom O'Halloran from Lord Abbett is bullish. So stay tuned. We'll be right back.
Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008 and most recently the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866 562 2634. Protect your capital and don't miss the next market uptrend.
Welcome back to Investing with IBD podcast, sponsored by Skoufis Capital Management. It's Justin Nielsen here, along with my weekly guest, Arusha Pires, portfolio manager at O'Neill Global Advisors. And our special guest this week is Tom O'Halloran. He's a partner and portfolio manager at Lord Abbett. So, yeah, I mean, you kind of laid out a number of reasons why you're bullish. And one thing I just wanted to kind of circle back to, because I think it's something that not everyone would expect of a mutual fund, but when you're giving the numbers of stocks that you own, uh, those were some pretty small numbers compared to a lot of your peers. Why are you kind of okay with that more concentrated position, and why do you shy away from the hundreds of stocks that many mutual funds go for?
Well, Justin, we've always considered ourselves to be active managers.
Mhm.
And if we have a good idea, we want to have more exposure to make more from it.
Yeah.
And if we're wrong, we can always sell and cut
Mhm.
Right.
losses.
Right.
I think that someone once said to me, ego and emotion are the assassins in this business.
Mhm.
And one of the most important things is to be able to take a loss.
Yes.
And that's all about humility. We're kind of trained to think it's about being right. We listen to the news every day, and we hear all these smart people, and they always sound like they're so smart and we're so stupid, especially people like me who are inclined to be bullish. The
Uh,
bearish people always sound so much smarter than I do, and feel like they're telling me tapping me on the shoulder, telling me how dumb I am. But
or
no, I'm an optimist. I'm an optimist. We're a product of our experience, and I was lucky enough after I left law to start out in investing in venture capital.
mm,
And I basically said, why is everybody so afraid of taking risk when there is this much upside in equities? And over the course of the past, since then, 30 years or so, The technology revolution has grown more powerful with each passing year. The technology revolution being measured by the exponential gains in processing power each year that have occurred. So that I look back, and when I started at Lord Abbett in 2001, and I consider today, and today, $1,000 of computing power buys you 100 billion times what it bought you in 2001, a human brain versus an insect brain. So I believe that the tech revolution continues to be very powerful and is enabling incredible innovation in the economy. It starts with the semiconductors and the software, which is generating the power. It makes its way to the consumer, where 2/3 of spending is, and it has an amazing, the capitalist system, the free market capitalist system, has an amazing ability to create solutions that meet our needs at the various hierarchy levels of our existence, the physiological, the safety, the belonging, the self-esteem, the self-actualization. It's ushered in things like e-commerce and social networking, which make consuming much better. And we've had huge advances in medicine with biotech and devices and diagnostics. And we have brand new markets opening up, you know, the electrification of everything, digital money. So I'm very, very bullish, looking forward over this decade and next decade, that equities are going to go a good deal higher. And you know, but our process, which uses technical analysis, recognizes that stocks have big cycles. Stocks go into bull markets. They last for the big winners. Sometimes they last 18 months. Sometimes they last as long as 4 years. And then there is a big bear market. And when that happens, we like to step aside. You know, Amazon fell 95% in 2000 to 2002. Names like Green Mountain Coffee Roasters, which got taken out, that was a big stock that we owned, went down 80%. I think it was in 2012. Netflix went down 80% in 2012. So these stocks, even if they keep going up year after, you know, over decades, they have these big corrections. And when that happens, we like to bring them down. But you know, but if you're gonna be successful as an active manager, you have to take risk, and you got to be able to withdraw risk. And so one of the ways you do that is through some greater concentration than being diversified, as Peter Lynch used to say in his book One Up on Wall Street.
So when a position goes against you, and when you're hitting your stop losses, there have been times where you don't hesitate, right? You know, you would think like a mutual fund would, let's just slowly, gradually move out of the position. I was pretty impressed after hearing that there are some times where the numbers are really bad after an earnings report, and you're like, let's just get out of it.
Yes, yeah, we're very decisive. I'll give you an example of Zoom. So the pandemic breaks out. I have a friend in the business who's a technician who calls me and tells me that he knows somebody who used to work at CDC, who tells him this is a really bad situation. So we immediately buy Zoom, and it zoomed. And to fund that purchase, we sold Live Nation, which we figured was not going to do very well if concerts got shut down. That plunged 60%. But then on vaccine day, Zoom fell from 520 to 420, and we were out 100%, because we said all of the upside that people were dreaming of is gone.
Yeah.
And
you were seeing it on the chart too, right? So
the market often taps you on the shoulder and says it's time to get out. And so yeah, we are very decisive.
That might not have been a tap, more of a slap.
That was a punch. That was a punch in the nose. Yeah, exactly.
But you know, to your point, you were decisive. You didn't kind of get a deer in the headlights like, oh, now we do. You just made the decision. Hey, it's time to move on.
You got to take the ego out of the equation. Okay, this is not about Tom. This is about the team of people that Tom works with. This is about following an investment process and trying to make good decisions. You know, there's just important decisions to be made all the time, and you just want to try to make good decisions. And one of the things that's important is to get a good night's sleep and make sure your mind is rested. I mean, I could spend all day reading about my companies all night, and but then I'd be making bad decisions about the stocks because I'd be cranky the next day. So it's you know, I love what I do. Every day I come in is like playing for the Stanley Cup. I played ice hockey in high school and college, and this is so exciting. Every day there's some drama, something to do, something to talk about, and but we're very active managers. But you know, when we see things like the vaccine from Pfizer, and then what followed after that is the Democrats took the Senate, so you lost divided government, and that, you know, created more fiscal stimulus, and that aggravated the inflation problem. Then you had the war in Ukraine breakout. That was unexpected. That aggravated, and so you never know what the market's going to throw at you.
Yeah.
But when it does, you need to think about the implications and then take action. We don't want to be, you know, I don't want to be, you know, our turnover in all these funds runs around 90 to 140% a year. I'd say a central tendency of about 125. The tax situation associated with that is better than would appear because we're more inclined to let the winners keep running as long as they're running and taking losses sooner.
Yeah. Yeah. Well, so now to that end, you know, you kind of had your Zoom example, which I think is, I mean, pretty extreme, just like, you know, that amount of a drop and you're just like, no, I'm not going to be any part of this. I'm not going to wait for it to return. Now, what about stocks where the move is a little bit more gradual? I mean, you were talking about some of these stocks that did come back, like Netflix and Amazon. Do you get out of them while they're going through that major corrective phase? We're talking about the 80% drops.
Oh yeah,
and then you just get back into them.
Yeah, you just get we try to get out of them when they're going through that type of phase, and then and what we'll see is we look at stocks in 4 categories, and one of the interesting things about our team is we have a full-time technician, Vernon Bice. So Vern's spending 100% of his time on the charts. And so we look at the world in terms of 4 frames. Number 1 frame is an uptrend. The 150-day moving average is moving up. The stock price is above that. That's something we're inclined to hold. If we don't own it and we have a good reason to buy it, we're inclined to buy it. And then there's a downtrend where the 150 is going down. The stock is below that. We're generally inclined to stay away from that. You know, you do have issues like you do have like the Googles and the Amazons and the Microsoft, which are so big in the benchmark that, you know, like Apple, for example, is 14%. So to be 0 in Apple is taking that's a big risk. So we don't do that. So but you know, when this and then the interim steps are an uptrend first becomes a pullback, where the stock price goes through the 150, and that puts the risk antennas up. That's basically, could this uptrend be coming to an end? And often it's not. And so we just say, let's just chill, and the fundamentals still look good. We think this will resume, but let's, you know, if we think there's something wrong, maybe it's appropriate to cut it. And if it keeps going down, then and the 150 starts to curl down, we're on the verge of a downtrend. So that might be what tips us out of a name. On the other side, a name that's been in a downtrend, when its stock price goes up through the 150, that could mean the beginning of a new bull market. So that puts up the opportunity antenna above our ears, and might be reason for us to buy it. Now, as I said, we're seeing a lot of snapbacks right now. It's better, and I said we use the 150. You could use the 200. We just find the 150 is a little bit better for us. But you know, if you have a snapback, it would be better if that 150 has come down long enough and is flattening out, and the stock price is lifting up through it. than if it's just gone straight down and the stock price is lifting up through it. So, you know, we use the technicals as an integral part of our process. It's, you know, anytime anyone asks me about a stock that I don't know of or I haven't looked at lately, the very first thing I do is let me see what the chart looks like as a starting point to begin thinking about what to do with it.
And so how do you, so, you know, you have a team, you have Vern managing the technicals, you have others managing the fundamentals. How do you balance that out? Is it, in the end, is it the chart that, well, what if it's kind of like in the neutral kind of place? Is there a kind of a debate there that
a tiebreaker?
Yeah.
Well, we have the three circles as our process, and you know, it's very hard to get somebody who has never learned technicals to stitch that onto their DNA.
Right.
It takes a lot of time, and we're very patient about it. You know, I have the final say. I'm the lead portfolio manager. I know that I myself, if I'm really good, will be right 60% of the time. So I hope the 40% I'm not, the people in the room will tell me I'm wrong. But you know, Matt DeSico has been a portfolio manager, you know, has been with us since 2002. Okay. And he's been he and Vern and I have, you know, have been the three amigos for a long time. And
that's awesome.
You know, we can finish each other's sentences. So I would say that, you know, we give rope sometimes if someone likes a name and it's just begun a snapback. We'd like to see a better technical profile. Maybe we might start with 50 basis points instead of 100. That type of thing. So
that makes sense.
So again, it's a team, it's a process, and you know, with mutual respect and an understanding that that's what it's all about. Everybody is you know, gets along well, and we try to make the best decisions we can as a team, and nothing more fun than winning as a team and putting up good numbers.
And you know, I just wanted to kind of circle back a little bit because we had talked about how, again, you're focused on growth, and I think that's where Arusha and I fall to. And again, this market has been very commodity related. You mentioned how a lot of the lists that you were looking at had a lot of energy, you know, splattered all over it. I mean, for a while there, you had the tankers and steel stocks and all of this. So, what? Remind me again, what is it that you do in this environment? And again, we're not quite sure. I feel like the sector rotation has kind of been a little bit tricky to handle lately, because even the ones that were working kind of seem to not be working, or it's shifting very quickly. So where are you putting your money in that regard? Do you just stick with growth that's maybe a little less volatile, or do you do some of that switching?
We definitely don't stand still, and our investment process has led us really since the day of the Pfizer vaccine to move toward a more defensive posture. And by that, I mean the search for operating momentum and technical momentum. And you know, when we're looking at technical momentum, it's not only absolute price momentum, it's also relative price momentum.
Yeah.
When you're in a bull market, you know, both are always important. But so I would say what happened was, as 2021 unfolded, that process led us to own much bigger positions in Microsoft, Google, and Apple in aggregate than we had in 2020. As time went along further, it led us to move into, you know, big healthcare services names and big pharmaceutical names. And we were probably too late to get into energy, but we got into energy with some pretty good size holdings at, you know, in the first quarter of 2022, I believe it was. So what happens is the investment process leads us to relatively better operating and technical momentum stocks as a way to try to beat the market and the peers that we're up against, or if that's not possible, to lose less to the market. But you know, we're offensive investors, so I've never seen a bull market that I didn't love to do a cannonball into. We haven't had that in a long time, but or any given stock. If there's a stock that's beginning a bull market, we're naturally inclined to move into that stock. So our investment process leads us to better operating and technical momentum, no matter what the environment.
Yeah. Well, we're going to get into some of the stocks that are on your radar, maybe some of those stocks that you're looking to cannonball into down the road. So stay tuned. We'll be right back, folks.
Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008 and most recently the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866-562-2634. Protect your capital and don't miss the next market uptrend.
Welcome back to Investing with IBD podcast, sponsored by Skoufis Capital Management. It's Justin Nielsen here, your host, and my weekly guest, Arusha Peiris, portfolio manager at O'Neill Global Advisors. And our special guest this week is Tom O'Halloran from Lord Abbett. He's a portfolio manager and partner there. So, you kind of laid out your case based on your process, why you're getting a little bit more bullish because of what you're seeing on the technical action. So let's maybe dive into some stocks that you have on your radar right now. And maybe we start with ARGX. And just as a reminder for folks that we do have this on video, and you can view that at investors.com/podcast if you want to see the charts. And Arusha's, usually pretty good about marking some areas up. So let's start out with ARGX. And this is a biomed biotech. You already talked a little bit about some of these. So what's interesting about this stock to you?
Yeah, all of these stocks that I'll talk about are names that we have good sized positions in. And Argenx is a commercial stage biotech. So they have a drug called Vyvgart, which has launched. The sales are exceeding expectations, and it's focused on severe autoimmune diseases. And it's from a novel llama, the animal llama derived antibody. And so this type of drug has many different applications it's a pipeline within a drug, so-called. The first one is for myasthenia gravis, which is causes severe muscle problems. It's an autoimmune disorder, and as I said, they got approval for the drug. The sales are exceeding expectations, so it's got strong operating momentum. The stock has a very attractive technical pattern. It's been basing for a couple of years and is kind of now lifting out of the top of that base. And so a very positive operating momentum situation and a positive technical profile.
So you're talking about the operating part, and if I'm not mistaken, I'm looking at the revenue here, and it looks like there's been a big drop in the revenue. Do you know what's causing that?
Well, the revenue moves around based upon their former drugs and the new drug. The new drug is ramping very fast, and some of the older ones reached a peak. But I'm looking here, and sales were 68 million in 2020 and 551 in 2021. So, some of the older drugs are rolling off, but we're really owning it because of the new drug Vyvgart, which not only has the application for this ailment, but many other autoimmune disorders.
And Arusha, you have a lot of kind of experience in the biology area, and I mean, autoimmune diseases. I mean, they can be nasty things. I mean, both my mother and my sister have autoimmune diseases, and I think that there's a lot of times where these stocks, are providing hope for some of these people, these novel drugs, and it's amazing where some of that can come from. I mean, from llama antibodies. So now the problem, of course, with some of these biotechs, I mean, yes, they do give you that hope, but sometimes the clinical trials don't go right, the approval doesn't get there, or some other, innovative technology comes and dwarfs it. So how do you manage your risk in this one? What is it that you have to keep your eye on in order to know whether your thesis is playing out as expected or whether there's a dramatic turn here?
Well, there's no other company that has this approach with this type of compound. The drug's already been approved for the indication that we just talked about, and the sales are exceeding expectations coming out of the gates. So we'll be watching that. I would say the most important thing we're going to be watching is the sales growth to make sure that that is continuing to really be strong. And then they have upcoming phase 3 for other types of autoimmune diseases, a couple of phase 3 results coming up at the beginning of next year. So we'll be watching how those trials go to determine whether we want to be as big as we are, continue to be as big as we are in the position size, or whether we need to cut it back or something like that. So basically, right now, we're watching the sales of this new drug that just got launched. We're looking forward to other indications which would be additive to the new drug. And that will determine the future course of this stock.
Any comments on the technical action here, Arusha?
Well, the immediate thing I noticed is the relative strength, just really strong relative strength. I'm measuring against the AQUI index right here, but yeah, incredibly strong, right near 52-week highs. The price is at 52-week highs, and so far, the market's agreeing with Tom and his team.
Yeah. Okay. Maybe we can take
if you look at the intermediate chart, this is a nice big 2-year base, and it has recently kind of taken out the top of that.
Yes.
Yeah, it peaked basically in the first quarter of 2021, and looks like it recently got above that level. Kind of now bumping its head potentially at 400. So we'll see if it can kind of clear that area. Also in the medical space, maybe we take a look at Insulet. Ticker symbol here is PODD. Definitely known for their innovations with diabetes, and it seems like there was. You had Dexcom, you had Insulet, you had a number of these companies that were kind of changing leadership. What is it about Insulet that kind of sticks out to you, Tom?
They have a new pod. The pod, sticks onto your hip or some part of your body if you have diabetes, and it dispenses the diabetes into your body with a little pinprick you can't even feel. When I grew up, people had to shoot themselves in the arm daily if they had insulin, if they had diabetes. So this new pod can connect to the glucose reader wirelessly and just automatically dispenses. You're walking along, and it'll send a message to your iPhone and tell you that it's dispensing insulin. So it's dramatically more convenient that you have a device here that can communicate with the glucose reader and automatically distribute that insulin as needed on a real-time basis without you doing anything. That's a big safety risk. But the fact that it cleared the FDA after who examined that very carefully, and now as this is launching, they're seeing exploding demand for it. They can't keep up. And the technical action shows you that this has recently entered a snapback, a nice move up recently. That 150-day moving average is curling up. So technically, we're not quite. We're almost in an uptrend in this name. So we think as this drug, as this device starts to sell, it will beat expectations, and that operating momentum will be really strong, and it will enable this stock to resume an uptrend and hopefully make new highs.
Yeah, one thing that comes to mind with this, especially the way you described it, is it seems really easy for people to get their insulin here. So that naturally is going to enable people to be more, to actually be consistent at taking the insulin. And also, opening up a larger market, right? So it goes back to what we were talking about before, just making it easier for people, just kind of one of those primal type of things that all of a sudden now, if they make it easier for people, they're going to open themselves to a larger market.
And let's not forget, I mean, you mentioned, a safety risk. There's also a huge risk of people that forget to do their monitoring,
Right.
maybe don't do the calculation right of how much insulin they need. And, it's not easy. I mean, if you were told there would be no math, that's just not the case, right? And so this is something that's doing the math for you. And I believe, correct me if I'm wrong, but they did have a partnership with Dexcom. So they've got, as you said, it's kind of a one-stop shop. They've got the glucose monitoring and the pump all kind of working together to provide almost like an easy process of what was a little bit more involved: the pinprick, the test, the administration of the insulin, rinse, repeat. And I think that was something that was frustrating for a lot of diabetics, that they felt like that was just their life, was always testing pinpricks and getting those levels right.
And as we know, this is a large and unfortunately growing market
Right.
for diabetes.
And I should say that we do own Pod in one of our O'Neill accounts.
So we did talk about energy. Let's go ahead and just take a look at Cheniere Energy. The ticker symbol on this one is LNG. Natural gas has certainly been a little bit diverging from oil lately, in a positive way, holding up a little bit better. What is it about LNG in particular, that liquefied natural gas, that you felt was growthy enough to get some money in there?
Well, we have an abundant supply of natural gas here in the United States, and it's much cheaper here than it is in Europe or Japan or China. And so Cheniere has the liquefaction facilities that convert the natural gas, which is in a gaseous state, into liquid, and then transport it to these other countries. Now, with the war in Ukraine, natural gas prices have just soared in Europe. And so Cheniere has extraordinarily powerful operating momentum right now. I'm looking at my Wanda screen right now, and they're going to earn $10, it says, in 2022, up from a loss in 21, and they're going to earn $18 in 23. And beside each of those estimates is a green arrow, which reflects the fact that those numbers have been raised. They've been raised a number of times this year, 3 times, pretty big. And the stock's in a rip-roaring bull market. It's a strong uptrend. And so it just, it meets all the circles. There's a big market for liquid natural gas. This is the leader. The operating momentum is super strong. The stock price is super strong. So right now we have a very good sized position, but should that change, we would change with it. But right now the momentum here is very powerful, and that's why we like Cheniere.
How much of this decision is kind of based on, okay, we've got the Ukraine situation. We also have winter coming. We've got these skyrocketing rates in Europe. So there's a lot of things that could affect that. If something different happens in Ukraine, there could be a big shift. So how do you kind of, with something that has that geopolitical risk, how do you kind of assess that situation that you have very little control over?
Well, you watch it day to day, right? I mean, I always read the headlines every day of, Wall Street Journal, New York Times, Financial Times. I read Barron's every weekend. I just look at Bloomberg News, and I just try to stay on top of the macro. And we have a phenomenal fixed income franchise at Lord Abbett, and they have to be on top of the macro more than me. It's all of what they do. And, we have chats here at Lord Abbett. One of my favorites is the Mostly Macro chat, which is lit up all day on all these macro developments. So we'll watch those things. If the winter turns out to be the warmest winter in European history, then that would not be good. If Vladimir Putin comes across the pond and gives Joe Biden a hug, that would not be good. For Cheniere, that is.
For Cheniere, yeah. Let's be clear.
It'd be great for the world.
Yeah.
But we watch
Give
those
peace a
developments.
chance.
We know those risks are out there. Those risks could be what upsets the bull market. But right now it's there's a stock that started going up modestly during COVID and is now probably in year 3 of a bull market. So I think it'll last 3 or 4 years. I think it'll go 4 years, but we'll see. We'll see if things change. We will. Right now, it's in a powerful bull market, and we own a large position here.
Yeah.
And actually, I mean, and these are the perfect types of stocks, right? Where you're using the 150-day moving average, you're just riding that trend up, and you're just kind of letting it do its thing and trying to do your best to kind of stay back, and you just keep moving forwards and not thinking about it too much when it's working.
And when it stops working, my guess would be it might be because inflation comes back down. Because the war is over, because the supply of natural gas has adjusted, and I'll only be too happy to go back to my favorite semiconductors and software instead.
Right. Exactly.
This is the best place to be.
Right.
Yeah. And, look, just to remind folks that have been looking at the video here, a lot of these are in very different positions than the indexes themselves and most of the stocks in there. I mean, these are things that it looks like kind of what correction. I mean, maybe Insulet is the exception there, but even that, you've got a very clear double bottom base, on PODD that it looks like it's coming out of. And it's, again, where it's at in relation to those moving averages is very different from a lot of the indexes, and thus that relative strength that you were talking about. So maybe from LNG to CMG, let's talk a little bit about Chipotle. I'll say, I haven't really eaten at Chipotle that much lately, but it's right around the corner from where I'm staying here in New York. I'm in a hotel room right now, and it's just one of those things, right? You can count on. Oh, it's right there. It's close, and I know what I'm going to get. What is it about Chipotle that is making this still on your radar after it's really been having multiple moves up?
Well, here's an example of a company that is exploiting the physiological level of the hierarchy of needs, and the food's delicious. The food's good for you. The service is great. And we bought this on the IPO back in 2006.
Oh, wow.
Wow.
Yeah, it came public at $22 a share. Well, we haven't been in it the whole time. We've been in and out of it.
Yep.
A few times during its bear markets. They had a food scare that forced us out of it, et cetera. But I'll never forget it was trading at $22 at 100 times earnings that year. And people thought it was way too expensive, and then it opened up at 44. First trade. Went up to 170 and then back to 35 and the meltdown, and now then on to 2000. But it's great food. They got a new CEO 3 or 4 years ago. He's done a remarkable job, and I go to Chipotle quite often, actually, and I think I've gotten the same exact thing the last 200 times I've gone. A meal bowl with white rice and black beans and corn and cheese, and they don't even bother to ask me whether I know the guac's extra anymore. So I always get the guac, and they put the G on the thing. So
do they just say the usual, Tom?
No, they don't. No, not that they know me, but they used to say, this is extra, and they don't say that anymore. They don't have to, and they must make a lot of money on the guac because it's only not that much,
right? And
it's $2.50. So here's a stock that's working its way out of a bear market. It's climbing up a right side of a big base and looking good. And this is one that did a snapback and is now technically an uptrend because that 150 has just curved back up. So sales growth here is. I'm looking at the the sales growth in most recent quarters. Looks like it's nearing 20% or so, and the margins are going up again nicely. pre-tax margin in 2021 was only 12. It had been as high as 17. So McDonald's pre-tax margin is 35. So this is a company that could get a lot more profitable over time. Earnings growth for 2022 is estimated at 29%. For 23 at 30, both of those estimates are up from the last estimate. So strong fundamental and operating momentum, and strong technical momentum here.
Yeah, and I should say we do own this for some of the O'Neill accounts. Now, any concerns about kind of just the consumer, where now Chipotle appeals more towards kind of the middle income, upper income consumer, but if the economy gets worse and worse, it's probably going to bring those tiers down too. Any concern about that, or are you just going to let the charts kind of tell you when to get out?
Yeah, I'll watch that. I'll watch the economy unfold. Right now, the consumer continues to be healthy overall, although it's weak at the lower end. We're seeing some, misses out of the Targets and the Walmarts and others, but people need to eat. People need to know, the younger people eat better. And this is delicious, relatively healthy food. And I also think longer term, they're going to have a good opportunity with robots to chop up the food, and they're already beginning to put them into their restaurants. So one of the reasons I think margins can go a lot higher. But I don't expect a bad recession. I think that there may be a recession. I don't think it will hurt profitability. The S&P estimates seem to be about 220 now, $220 a share for 22 and 23, and maybe those go down to 200. Maybe it goes down to 180. I don't think that if it goes to 120, that's a problem. But I don't think it's going to go down that much. I think the consumer will hold in there. Labor markets are still strong, but if that picture changes, and we'd see it in the stock, and we'd realize that we shouldn't own it as big as we own it.
Well, and there's still a time factor in terms of how much time you can save, especially with some of those things that they instituted, where you can just put your order in. It's just waiting right there on the shelf for you.
Yeah.
And I'll just share with you that for me, I did try the garlic guajillo steak most recently, and that's pretty gosh darn good. So
you're tempting me to change my usual order.
Hey, you know what? That's what I'm here for. We'll turn this into a little bit of a foodie show.
But you make a good point. You make a good point. They've done a very good job with the digital ordering.
Yeah.
Although I love to invest in tech stocks, I myself am not that good using the tech. I rely upon my 4 daughters and my wife. My wife has got the same problem I do, but we rely upon our 4 daughters to help us with that. But they've done a nice job with the digital ordering.
Absolutely.
Yeah, it's really, really convenient. So
yeah.
Maybe we just go ahead and go full technology and futuristic Tesla. We can end on this note. Ticker symbol TSLA, of course. Now, it had such a phenomenal move again in 2019, 2020. 2022 has been a little bit rougher. Is this time for a comeback on Tesla?
Yeah, I'm pulling up the long-term chart on the short-term chart on Tesla looks good. It has just done a snapback. It is in the midst of doing a golden cross where the 50-day is rising up through the 150. But when we look a little longer term, especially on a monthly, we can see we had, as you say, an enormous move up in 2019 and 20, and we had an enormous move up back in 2013.
Right.
And we owned it back then in pretty good size. It was a 10 bagger, and then it was a bad stock from 2014 until October 2019. And I walked in here one day and it was up 25%. And I said, what's that all about? That's a very big move for a large cap stock. And Steve Wortman, our industrials and consumer guru, said, I'll dive into this, and came back at the end of the day and said these sales and deliveries are really ramping up like they haven't in a long time. And this fundamental operating momentum is all of a sudden really improving. And we got in that afternoon or the next morning.
Wow.
And then we had after that enormous run up, we had a big pullback in this name, right? We got up to 1,200, and we came all the way back. We split here. We split.
Yeah, that was before split, right?
So this went up to 400. It was a 3-for-1 split. That's right.
Mm-hmm.
We went from 400 down to 200 here.
Right.
So we had a 50% correction.
Yep.
And as that was happening, we lowered the position size. And then as it started improving again, we built it back up.
Okay.
So I think this is this is the big stock for the first half of the decade, and maybe the decade, because there is just an enormous demand for electric vehicles. Some huge legislative push behind it in the interest of climate change and cleaner air. But there are many hurdles. Are we going to have enough lithium? We own a lithium company. We own a couple of lithium companies in the portfolios. Are we going to have enough lithium? Are the batteries going to improve enough to make it more efficient? And things like that. And we don't know. And we could get to 2030 and not hit the targets that we are aiming for. Mm-hmm. But the stock might go up a lot in 2022 to 2028 before that becomes evident. So let's say, I think the drop of 50% is enough to restart a new bull market. So I think Tesla's begun yet another bull market.
That's interesting.
Yeah, and if we look at the fundamental block, their earnings are going to grow 80% in 2022 and 45% in 2023, and both of those estimates are up. I look at
not small numbers. I mean, that's $4 per share for 2022. So.
Yeah. All of a sudden, it actually has a multiple, and that multiple is above market, but it's not NA. Tesla is a top 5 position today, and I think that it's way ahead of the other electrical vehicle makers, way ahead from many perspectives in terms of its supply chain, its ability to manufacture, its brand name. So I'm a big Tesla bull.
Mm-hmm. And it's been very resilient over the last couple of months. While a lot of these other tech stocks have gotten hit, I've been very, very impressed at how well Tesla has hung in there.
Yeah, so if you look at that squiggly relative strength line below the stock price, you can see that it's 91 now, and it's lifted up nicely over the recent time period.
Mm-hmm. And as we've learned, time and time again, it's these stocks that are holding up well, the ones with the best relative strength. Those are the ones that do tend to become leaders in the next bull cycle. So if one is truly around the corner, as you suggest, then this is where we go do our fishing, right?
I think, absolutely. I think the power of the technology revolution is greatly underestimated. I think not only in terms of its ability to generate growth for companies, but also in terms of its deflationary effect. And I think that the quality of businesses today is greatly underestimated. They are much, much better companies than they were 30, 40 years ago. Mm-hmm. So, I'm very bullish on our strategies. I know that we've been in a very difficult bear market. I see signs that the market's bottoming. I see stocks beginning to show relative strength, the types of stocks that I like. We've talked about 5 names here. None of them are in tech yet, but I would expect if we talk 6 months from now that we'd have some tech names back in. in the portfolio.
Well, maybe if we see a big turn, we'll have to have you back on, Tom. We really appreciate you coming back on the show today. It's always good to hear your insights. And again, Lord Abbett, of course, is one of the members of our IBD Mutual Fund Index, one that we've been following for quite a while, because you guys are looking at kind of the same stocks that we do. So we appreciate you sharing your insights.
Hey, it's so great to see you, Justin and Arusha, and thank you so much for having me on.
Oh, a pleasure. The pleasure is all ours. Okay. Well, thanks again, Tom, for being on. And that's going to wrap up our show for this week. Next week, it's going to be a little bit of a we time. Arusha and I are going to chat a little bit, not just about our fantasy football woes, but also about what's in store for the market and where things stand now that the market would have had some time to digest these most recent rate hikes. And we'll see what that holds in store for us. We hope you join us next week. We'll see you then. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.